Good afternoon, JT Engstrom with FreightWaves here. With me today, I have a special guest, John Larkin, presently operating partner at Clarendon Group. In previous life, he was an investment banker at Stifel, and as well as an equity analyst just before that. His experiences are deep and vast in the transportation space, including stints as the CEO of Railworks and a banker at Alex Brown, as well as a multitude of other roles, including executive investor, advisor, student of the transportation industry. John, welcome. It's good to see you.
It's good to see you, JT. Thanks for having me today.
How are things down in the Big D?
Well, pretty quiet. Normally it's a bustling city, but everything is still closed. There's some talk that the city may be opening up here in the next week or two.
Yeah. And now you're known to pound the pavement and be on the road a lot, fly a lot, see clients a lot, constantly gaining new knowledge. What's it like transitioning to a work from home environment, given how proactively you're always in front of the industry?
Yeah, that's a good question. I've not flown since the week of March 10th, and it was interesting that week. There are very few people flying. I ate at a restaurant at the Cincinnati airport. I think there was one other person in the restaurant. It was an Outback Steakhouse. You could have played football in the concourse of the airport. But since then, I've been locked down, and instead of spending 4 hours to get to a city, an hour in a meeting, and 4 hours to get back, trying to do that type of work via telephone, which actually is a lot more efficient.
That's right. Thank you for joining us today. The title of our talk is The Role of Private Equity in Trucking, Logistics, and Freight.Tech Now, which is a subject that I know you have a deep wealth of knowledge on. I think it'll be a lot of fun to talk about. I think maybe to set the landscape a bit ahead of diving straight into private equity, maybe given your background, we could talk a little bit about the evolution of equity capital in transportation, broadly speaking, of which there's been a few stages, and you've played in all of them over the past few decades. I think that gives you a really unique perspective, which people would be interested to hear about.
Yeah, I think that's a very good question, JT. When the industry was deregulated in 1980, there weren't very many public trucking companies. And all of a sudden, what really mattered was cost and service. And there was a fellow up in Northwest Arkansas named Johnny Bryan Hunt, who thought he had a strategy for lower cost and better service. And as he grew that business, when he reached about 60 million in annual revenue, he thought it might be a good idea to buttress the balance sheet and did an IPO. Back in those days, a lot of trucking companies were really viewed as growth companies. They had a strong position in the marketplace, better cost, perhaps better service, or both. And that enabled them to grab market share from some of the regulated carriers who existed just because of the ICC allowing them to exist. Their costs weren't very well managed, and their service was very erratic. So it was really fun to watch the industry emerge, really, as we know it today, as a series of growth companies. And I think J.B. Hunt really sort of led the way, and they continue to lead the way today. They've done an awfully nice job morphing as the industry has changed in focus. I would say that we went through a secondary period of what I would call M&A, where you saw companies doing strategic acquisitions. In trucking, those were very difficult to integrate because the cultures were different, the systems were different, the pay scales for drivers might have been different, the equipment philosophy may have been different. There are very few of those that really worked out well. There are a couple you could mention, like maybe a Landstar could be a shining example, but most of them failed. And then I think the third chapter of what I would call capital raising on Wall Street for trucking companies emerged with private equity really coming to the fore with all of the regulations around being a public company. Many companies decided it would be easier actually to have only one group to answer to, and that would be the private equity firm. As it turns out, private equity pretty quickly realized that EBITDA was not all real for trucking companies because, particularly on the truckload side, there's a very large need to replenish the assets. Most of the tractor equipment is replaced every 3, 4, maybe 5 years. Trailers are replaced every 8, 10, 12 years. And that means that a lot of the EBITDA has to be reserved to replace the equipment. And if you put a lot of what I would call LBO debt on a company, then you find just how difficult it can be being owned by private equity. So private equity kind of moved in the direction of investing primarily in asset-light companies, which don't have that replacement CapEx demand. All they have to do is really fund their working capital growth, maybe some investment in technology. And then the last and current chapter that we're in now really is the venture capital boom. And we're seeing an awful lot of money being invested in early stage companies, one of which is FreightWaves, of course. But there are many others. A new one that I talked to last week was Baton Trucking, which has a really fascinating story. You may have met those folks, John. But I think venture capital is saying that, gosh, here's an industry that really hasn't benefited from a lot of technology, and maybe now is the time to take functions that previously were very archaic, involved a lot of people, a lot of phone calls, faxing, and other laborious functions. And let's see if we can automate some or all of those and inject some efficiency into our network. And we're probably in the top of the first inning of that venture capital era, and I think it's all very exciting when you look at some of the companies that are emerging.
I think that's a great breakdown, and I really appreciate that, especially after having had so many experiences with you personally along these lines. And your depth of knowledge across each of these equity capital structures as it parlays to the cross-section of all the different subsectors in transportation is incredibly deep. And given that, I'm interested to hear a little bit of commentary from you on what you see as some of the pros and cons of each of these capital structures for trucking, asset light, and then perhaps what I'll just call early stage, but maybe not necessarily Freight.Tech. And some capital structures are better positioned for other sectors than others. And I know you've actually worked at the intersection of probably every combination, which gives you a very unique perspective.
Yeah, the public market, interestingly, is a very unforgiving place to be. And the reason for that is that public company investors focus on earnings per share every quarter. And if you miss your earnings estimate by a couple of pennies, it could create a 20% downdraft in the value of your stock. So it's really not for the faint of heart. If you are a true growth company and can use the capital raised in the public markets to drive additional growth, then I think being a public company is a great way to go. But if there's any kind of cyclicality in your earnings stream, it can be very frustrating when you go into a period of freight recession or economic recession or a period when the market is just out of favor. A lot of times the asset-heavy companies are the ones that get hit the worst. And we've seen that really over the last probably 12 months or so, where some of the maybe less well-established trucking companies have absolutely been hammered in the public marketplace. So, I guess the public marketplace really today perhaps unlike the 80s, where there was more tolerance for smaller, less sophisticated companies. It really pays to be a big company with a very sophisticated financial reporting system, full-time investor relations staff who can really control the message, and deal with all the analysts and all the portfolio managers that you need to talk to, so that the management team really can focus on operating the business. Private equity has become almost the de facto standard in the last 10 years, and management teams, can seek private equity, perhaps with firms that have an expertise in their area, and form really a partnership with that private equity firm to really drive accelerated value creation, let's say over the next 5 years or so. And if you're not, interested in selling your business and squeezing the last dime out today, that type of partnership can really be valuable. A lot of times, executives who roll forward some of their equity end up earning a much higher valuation on the equity they roll forward, as opposed to the valuation perhaps they received at the time of the private equity investment in the first place. So I think that's a good way to think of private equity. If you're looking to squeeze the last cent out of the valuation of your company, you should go out and hire an investment banker, and run an auction, and go out to your 500 closest friends, and there will be someone who will pay top dollar for the company, who's not really interested in you rolling any equity forward, will probably replace you anyway as an executive at the company, and really control that business going forward. So, I think at the end of the day, there are a couple of different flavors of ice cream here. On the PE front, there's that partnership model, and then there's the sort of short-term value maximization model that I just mentioned. And then on the venture capital side, companies that are still unprofitable, with negative cash flow, with cash burn rates that are sometimes quite large, have been very successfully tapping into the venture capital community, because the venture capitalists believe that as that company really leverages its unique technology, typically gains market share, they will be able to, at some point in the future, turn on the spigot to drive free cash flow and get a strong valuation in either the public marketplace or the private equity marketplace. Venture capital today is quite a bit different than it used to be, in that, in the old days, you might raise a couple of $1 million in a seed round, maybe a couple of million in an A round, maybe 4 or 5 million in a B round, and you'd be done and off on your way to profitability and positive cash flow. Today, it seems to go on kind of forever. And some of the investments made by venture capitalists are extremely large, actually, hundreds of millions of dollars at a clip. And you sometimes scratch your head and wonder how these companies can actually put that much money to work. How many programmers can you hire? How much code can you write? And why isn't it a lot more differentiated than it appears to be, given all the money that's being poured into the development of the system? So, at the end of the day, it's an exciting time. Fortunately, technology is coming into the industry at a much accelerated rate. And I think those companies that think they can continue to prosper by not investing in technology are going to be in rough shape within, say, 3 to 5 years. Because I think within 3 to 5 years, a lot of the decision making is going to be automated. There are going to be a lot of optimization routines out there. And if you're still making decisions with 3x5 cards and coffee cans, good luck to you.
Yeah, T cards, and you and I have certainly experienced the market making capability in sell-side transactions with respect to how many private equity investors will at least receive a confidential information memorandum. In a world with so many private equity investors, how do you use your deep domain expertise and your ability to add value above and beyond just capital to be able to help grow both an operating company and equity value for the operating partners within that platform? I think that's really interesting commentary to hear from you.
Yeah, I mean, I think most private equity firms are generalists. They work with a whole variety of different types of companies, maybe healthcare companies one day, technology companies the next, and they don't have the deep domain expertise in transportation and logistics. And I think that deep domain knowledge allows you to work hand in hand with management, perhaps to introduce the company to new customers or new strategic partners that they hadn't been introduced to before, to experiment with expense reduction strategies that maybe have been successful at other companies that the company you just invested in has not yet tried. I think one of the values that private equity firms like Clarendon can add is to find executives to round out a C-suite that may be lacking 2 or 3 key people to really build out a first-class management team so that valuation 3, 4, and 5 years from now will be dramatically enhanced. So those are the sorts of things that we do. We also work to help the acquired company find tuck-in and bolt-on acquisitions. Most companies do not have dedicated M&A talent. So if you pick the right private equity firm, they can be very helpful in identifying very high quality, in many cases proprietary bolt-on and tuck-in acquisition opportunities, which is a way to, in many cases, create value at a very accelerated rate.
I think that's great commentary. And now, for any operating companies thinking through their way to navigate their first or perhaps second private equity relationship, can you talk to us a little bit about any recommendations or sage, worldly advice you may have for them?
Well, I think probably the way to come at that is to decide really whether you want to develop a partnership with a private equity firm or whether you want to achieve sort of a maximized valuation at the outset. And I think if you're looking to find a maximized valuation at the outset, then it's probably best to hire an intermediary like an investment bank who can, basically introduce you to a bevy of private equity firms, and then you can, perhaps pick the one who offers the highest valuation, or alternatively, pick the one that you tend to connect with culturally the best. I think that you could have the strongest relationship with because you're going to be working with these people for a long time. If you're looking for more of a industry-specific partnership, there aren't too many firms that specialize in just one industry. Okay, in the transportation logistics space, there's just a handful of firms that really focus on this space. And without too much trouble, you ought to be able to identify who those are, maybe have a meeting with those folks and pick the one that you feel most comfortable with. You probably avoid having to hire an investment banker as an intermediary to conduct an auction in that case.
I think that's tremendous advice, and I think the advice you can give to a lot of operators is absolutely incredible, and anyone who has the opportunity should seek it out. So with that, we're running out of time, but it's great to see you. Thank you for your time. Thank you for all your advice, and thank you for your mentorship.
My pleasure. Thanks for having me on, John.
Have a great day.
Take care.